Appreciate you taking the time out to do this, Scott. For everybody that's on here, so I see some of the people from my organization are on here as well. Um, just a little bit of background on Scott. He's been with Symmetry. I've known him for about 2 years now, coming up on 2 years. And he really, when Debt Free Life came out, he really got it from the beginning. I think his most recent count is up to close to 50 families, representing was it over $30 million in debt retired when the plans are completed, and improving people's retirements by nearly $100 million. So, I can't think of anybody. I've helped about a half dozen families relative to what Scott's done. I can't think of anybody better to take the time out and kind of explain from his unique perspective how this can help either you if you're looking into this for yourself, or your clients. And we're both here, and there's several others of us here to help you explain it to. But with that, Scott, you do such a great job. I know you take time out of your busy day to do this, and really appreciate it.
Thanks, Tom. My wife has just instructed me that I need to move my camera down, but why you guys want to see my face, I have no idea. So maybe I should turn the light down a little bit so you guys aren't blinded by my baldness. Anyway, welcome to Debt Free Life. Today is Thursday, the 28th of May, 2020. Thank you, folks, for joining me. And this is something we do every week. Sometimes we go into different topics, taxation, college planning, things like that. Sometimes we just go kind of wherever the wind takes us. But always there's going to be a central kind of a basic explanation of what debt-free life is, how it works, what it does, what it can do for you, those kinds of things. So without any further ado, let me go ahead and get started with that stuff. So here we go. This is Debt Free Life. So you're here for a couple of reasons. You're here either because you're a Symmetry agent, broker, or underwriter, and you're looking to get more information and get a better understanding or better grips with what Debt Free Life is. You might be here as an invitee from one of our many agents and brokers and underwriters who thought that this might be a good solution for you and wanted you to get some additional information about it. You might be one of my clients, and I sent you here because this is something where I can I can help multiple people at one time and tell basically the general information to everybody at the same time. But whatever reason why you're here, you should count yourself lucky. Not because me, but because of Debt Free Life, because of its existence, because of Symmetry, really, Symmetry Financial Group. So Debt Free Life is a proprietary product. It is something that is new to the industry as of July, or actually June of 2019 was the first time it was made available in all 50 states. And it is something that Symmetry, most of the agents, brokers, and underwriters here have this near and dear to our hearts, simply because this is the debt that we have in this country is something that's affecting all of us, and it affects not just financial impact, but also the emotional and psychological impact of having that debt. And I don't know, when I was younger and I was in serious debt, I would lay awake at night and this would bother me, and it would affect my sleep and affect my health and the whole 9 yards. So what we do here, this is again nothing new. It's just this particular product, Debt Free Life, is new. The concept is not new. And what Debt Free Life is really, it's a different way to spend money than you're accustomed to. And the words Debt Free Life is kind of a play on words. It's a life insurance policy at its core. That's really all it is. It's a whole life insurance policy with some very special and unique riders that are necessary to make the system work correctly. It is secure. How secure? It's as secure as the state insurance board in which the state in which you live. It's as secure as the capital associated with the company that the policy is written on. And then even moreover, in many cases, it's actually co-insured by lots of other companies in whatever state you live in. So it is also It is a tax exempt vehicle, and this is because of some special IRS tax codes that were put into law many years ago. We're just taking advantage of the code. We're not breaking the law. We're just using the law. And this is something that, like I said, it's not new. So let me get going. It's one of the two reasons why you're probably here is either that you don't have 100% confidence in your retirement, which many of you, if you have a 401k or a 403 or a TSP or something along those lines, you should be questioning the ability for that retirement vehicle to perform the way that you've been presented that it would perform. More often, those words were not would, but the word was probably could perform. So one of the things that's one of the key things I like to highlight here between this vehicle and a 401k or any of those other retirement plans is that what we show you, it's not a could perform, it's a will perform. So what we show you today, and when you get back up with your underwriter broker who invited you here, they're going to be able to show you a plan that if you follow the plan, it will perform exactly as the plan shows you it will. It will show exactly when you're going to get out of debt. It will show exactly how much money you're going to be making and how much money you're going to have at retirement. And it's also going to show you exactly how much you can take as tax exempt income. The other reason why you might be here is just because of what I just said, debt. Most people, most of the folks that Symmetry meets are typically people that have mortgages, because that's usually the method in which case the requests for our services come into play. And if you've got a mortgage, you've got a debt. And one of the things that I've heard many times is, what if the only thing I have is a mortgage? Will it still work for me? And I just went through all the numbers that I've been all the people that I've worked with, and I've got at least 4 people on here that the only debt they had was a mortgage. And while we didn't have a snowball, we'll understand what that means in a few minutes. We didn't have a snowball that we could use. It still ended up performing and getting them out of their mortgage at least 15 years sooner than normal. So, and that was based on a 30-year mortgage. So will it work for you if the only thing you have is a mortgage? Absolutely. How well will it work for you? Depends on where you find the money. There's other places to find money, and that's what we'll talk about in just a few minutes as well. So again, as I mentioned earlier, this is a proprietary product. It's from Symmetry Financial Group. There are only 3 carriers in the country that offer this product, and all 3 carriers are partnered with Symmetry Financial Group in offering this vehicle. So you folks really got lucky when you ran into a Symmetry underwriter or broker to help you look at this particular product. So this is what the average American household looks like. About 3% of the money that we make over time is collected as savings, and that's for our retirement. About 34% of the money, that's 34 cents of every dollar you make, about 34% is paid out as interest over time. About 40% of every dollar is paid off in the form of taxes. And you have everywhere you turn, there's a tax, whether it's to get a fishing license or to pay your real estate taxes or to pay tax on your income. You're paying taxes every way, shape, or form. And then the last part of that is that 23% mark. And that's what you're using to live on. That's your lifestyle money. That's what you're using to pay your power bill, your gas bill, put food on the table. And then if you've got some money left over for entertainment, pay your Netflix bill, pay your cable internet bill. And when we could do it, go out to the movies, go catch a ball game, go catch a show, whatever. That's where that 23% goes. So with that, we should read between the lines is, that means that you are accustomed to living on 23%, 23 cents of every dollar to live your lifestyle. And this is definitely not what our forefathers had in mind when they set these programs up for us. This is not the American dream. When we talk about how much money we make as Americans, the truth is the average American makes about $2 million in their lifetime. It's a lot of money. So we make, as Americans, plenty of money. And that's not really a huge concern. But what the problem is that through the course of taking those huge interest payments that we make and the large amount of taxes that are taken from us, we don't really have an opportunity to save more than what the average American has, which is, as you see here, $60,000. That's not a lot of money. So if you think for a minute how much money you make right now, maybe you're young and you're making $15,000 to $25,000 a year, very low. Okay. So that sounds like $60,000 might sound like a lot of money. But when you get into your 40s and your 50s and you've got a house and car payments and kids and a wife or a husband, and then you're looking at, wow, that's $60,000, that's going to go for about a year. So this is the huge problem that Americans are facing, is that we don't have enough money for retirement. And one of the things that we're going to show you here with Debt Free Life is we're going to show you a way to change the debt paradigm. We're going to turn that debt on its head. We're going to make the effect of compound interest that you're experiencing when you got an interest rate on any debt that you have. We're going to turn that on its head and make that work for you. Okay. We're going to turn that debt into an asset. And we're going to turn that debt into additional retirement. And that's the magic, if you will, of what we do here at Symmetry and what Debt Free Life is. But one thing I'll say, it isn't magic. It's just math. Okay. And it does work, and the math doesn't lie. So let's move forward, go do a little bit more and see if there's anything else I need to say about here. Yeah, we pay too much taxes, pay too much in interest. Okay. So this is when you go to someone and talk to a debt manager, someone who does debt consolidation, someone who does debt elimination. They're going to say things like, just go out, work a better job, cut your expenses down, go eat ramen and tuna fish, pretend like you're back in college again, refinance your debt into a home equity line of credit. There's some other people that teach different variations of infinite banking that use that methodology, which I think is completely asinine, because why in the world would you give away equity in your home to pay off a debt that doesn't have any right to any of the equity in your home? It's silly. Consolidate your debts, great. So let's make it all so we can have the ease of having one payment. Does that make any sense? The one thing on here that I do agree with is the debt snowball. And that's down there at the bottom. Let's talk about that for just a second. What we do here at Symmetry and with Debt Free Life is true debt snowballing. And a true debt snowball does not mean you pay off the highest interest rate thing first. It doesn't. And actually, when you run as many illustrations as I have and you've seen as many of these things, you're going to understand that more often than not, the best and most efficient way to get out of debt and to build the largest retirement hardly ever involves paying off those debts in order of highest interest rate first. Okay. And we'll talk about that in just a few minutes. So what we do here is we practice true debt snowballing, which means there is, no matter how you look at it, no matter how you slice it and dice it, there is absolutely a best way to get rid of your debt and a best way to have the biggest retirement possible. There's only one way. There's, millions of permutations, but there's only one best way. And so what we do here is we'll show you that with our software, and we'll teach you that. So moving on, this is what we're getting ready to talk about, the best way. The better way, it's actually the best way. And the best way to do this is going to be to focus on, again, the end game. And the end game is which way at the end of this period of time is going to give you the most amount of money in your retirement. And I have yet to see that not coincide with which way also gets you out of debt the fastest. Okay. So we're going to create a solution for you that's going to fit within your budget, because this is, at the end of the day, if you can't afford to do this, it doesn't matter. We're going to find places where you're spending money inefficiently. What does that mean? So if I go to Starbucks 5 days a week, I'm spending money inefficiently. If I pay $200 on my credit card, but I only owe $75 a month as a minimum payment, then I'm spending that $125 inefficiently. So this is what I'm talking about. Moreover, if I've got that 401k and I'm contributing 6% of my income, but my company's only matching me 2%, then I'm overspending 4% at least. Okay. And really the reality is if you compare apples to apples, the end result is these plans are going to work out about 85% of the time better than a 401k. 17 out of 20 times it's going to be better. Moving on. So what we want to do for you is there on the right. What you're currently experiencing is there on the left. Am I happy with 3% of my total amount of my income going to savings so that I can have my $60,000 total retirement? No. Is it going to work for me? Absolutely not. Am I going to be stuck relying on potentially family members, relying on the federal government? Good luck to bail me out, right? And they spend money like it's going out of style, right? So what, 2.2 trillion, and they're trying to do another 3 trillion right now. And for those of you that are under 50 years old, I just wanted to take a personal moment to say thank you very much for allowing me to retire on time, because I'm over 50 and you guys are going to get stuck holding the bag to pay back all those taxes. So thank you. Anyway, moving on. So what we're trying to do here is we're trying to change the paradigm here of how you spend money. We're not changing how much you spend. We're just changing how you spend it. So if you follow the plan that's going to be created for you, what's going to happen? The first thing you're going to see is that taxes down at the bottom of each one of those two. We're going to reduce your taxes from 40% of your income to 30% of your income. That's an over the time reduction. It's not instant, it's not immediate, but you'll see it over time. So that 10% comparing left to right is actually a total of 25% reduction. 10% of 40, 25% of 40% is 10%, brings us down to 30. So what we're talking about doing is reducing the amount of taxes you pay over time by 25%, which is huge. Where's that money going? Well, it's not going to the federal government. It's not going to the state government. It's going either into your bank or into your pocket. Either way, you get to keep it. And from my perspective, anytime you get to keep more money is a good day. So what we're going to do is we're going to allow you to keep more money. That interest rate is going to get dropped from 34 to 24. Huge, huge drop. That savings is going to be increased from 3% to 15%, right? What is that? That's a 500% increase in the amount of retirement you're going to have. And I was just looking at the numbers that I've worked through with the families I've worked through so far. And actually that's light. That's very light. I'm not seeing a 500% increase in retirement income. I'm seeing 1,000%, 1,500%. It's huge. All right. So all we're doing here is we're putting more money away by default without you having to think about it. We're putting it into a situation that's going to earn a guaranteed interest rate by default without you having to think about it. That interest rate is going to be compounded monthly, again, by default. And it's going to be paying a dividend. So all these things are happening for you behind the scenes automatically with debt-free life. You don't have to think about it. All you have to do is follow the plan. And plans change. We know they change. That's okay. We'll just make an updated plan. Last thing I want you to look at there is that lifestyle. Let's talk about that for a second. So that lifestyle change, when you go from 23% of your expenses being left, 23% of your dollar being left over at the end of every month to 33% being left over, think about this. If you have in your normal checking account $1,000 left over every month, okay, and that would represent 23% of your total dollar, we're going to increase the amount of lifestyle money you have by 43%. That means you've got $1,430 left over every month. That's huge. $400 a month extra. I mean, for me, that's huge. So that's what debt-free life can and will do for you if you embrace it, if you follow it. It's a little bit hard to understand, and that's why you're here today. So hopefully I don't confuse the issue. But this is what we're trying to do for you. We're trying to get you over to that right side of the screen where you've got more of your money that you get to keep. So we've gone one more observation I want you to make. So the savings that you have there on the left side of the screen is 3%, and the lifestyle money is 23%. That means you are currently able to keep 26% of the amount of money you make, either in the form of savings or lifestyle. We're going to get you over to that right side of that screen. We're able to keep 48%, almost half. So that's almost double the amount of money that you've got for savings and for lifestyle. That's what debt-free life will do for you. It's huge, okay? So how do we do it? We do it by reducing the amount of interest that you're going to pay. We do it by, this says eliminate the debt in 9 years or less. I just ran all the things that I've done, and what I'm seeing is the average time that it takes to get out of debt is actually 8.6 years with the 45, 6, whatever, 8 cases I've done. But the time is the critical thing here. It's not just how quickly can you get out of debt, which is important. but does it work for everybody? I mentioned this earlier. The worst case scenario for everybody that I've worked with so far is 15.9 years. And that's really because the only thing they had was a 30-year mortgage. So without them spending more money than they were already spending, just changing the way they spent their money, we cut off 14.1 years of payments. That's huge, going right into their pocket. And the fastest I've seen it work for anybody was 2.3 years, which is fantastic considering they were looking at a 27-year solution going their current methodology. The other ways we do, the other things we do that affects this is certainly we're going to reduce your taxes that you're going to pay over time. Obviously, we've been talking about this for a minute, the increase of your lifestyle, the cash flow that you have. And the tax favored income that it mentions down there, this is the most favorable as far as I'm concerned of taxed incomes, which is zero. I can't think of any more favorable tax than having zero tax. So moving on. So one of the other things that when you look at some of the other systems that have come before us that tried to do this, what we're trying to do, many of them failed for a number of different reasons, but one of the primary reasons they failed is because they didn't plan for the unexpected. And how do you do that? So when we set up plans for you folks, what we're going to be doing is we're going to give you a game plan, give you a roadmap, show you what debts are going to get paid off, when they're going to get paid off, the whole 9 yards, right? We're also going to hide some of the money, not because we're trying to be sneaky. It's just that's the normal process. So about 20% of the cash that you're going to have available, and if you were at the beginning of this call, you heard a gentleman and I speaking about this briefly. 20% of the money is going to be hidden in as the cash value of your whole life policy. You don't see it. You don't need to know about it. It's there. Just be comfortable knowing that it's there. But that's your real emergency money. So I don't know many people who run into the I need to buy an emergency jet ski, or I need to buy, that emergency, I'm a coin collector, so I need to buy that emergency coin collection. That's not what that money's for. That's for true emergencies. Got laid off for a year. New roof, got blown off, you got tornadoes and all that stuff is happening, but you don't have the ability to get somebody out there right now from your insurance company to get you the money to put that roof on, pull the money out, get them to pay you back, put it back later. Okay. It's an emergency fund. It's cash. It's your cash. You can take it. It's not taxable. Okay. As long as you haven't exceeded your basis, and it's near impossible to exceed your basis with these plans. So the idea here is because we are looking at a solution where we're building in that 20% safety net, if you will, then we are very comfortable that the 80% building that we're doing, that long term, when we're churning and burning, getting the guaranteed interest rate, getting the dividend, taking loans, paying off debts, snowballing the debt end, which is how this thing works, then we are confident you're probably never going to need that 20%. And you don't need to see it, but rest assured it is there. This plan is, like I said, it's not anything, the concept is not new, but debt-free life is. And this is when we do an analysis of how a debt-free life, which is a tax-exempt, tax-free retirement solution, as compared to a tax-deferred retirement solution, kind of like a 401k. This is a side-by-side comparison with real numbers, with a real history, using the actual history of interest rates over time over the last 28 years. So if you started with a $10,000 investment in our tax-exempt retirement plan and put another $10,000 into a 401k that had a pretty good return, which is averaging a 7% interest per year, which is pretty good. Usually you only expect about 5%. Then the end result is same $10,000. One of them was a tax deferred. One of them was a tax exempt. And no matter how you look at it, no matter how you slice it, the tax deferred is going to outperform the tax exempt is going to outperform the tax deferred every time. And how much? That's $16,000. Fast math. What is that? Well, let's look. 16 divided by 49 that's 32%. So our system outperforms the tax deferred system by 32%, no matter how you look at it. So do you want 32% more money? Well, here's how you do it. So moving on. What is debt-free life? How does it work? It's got 3 parts. Okay. It's got the maximization phase, which is where we get you out of debt. How quickly? Depends. Depends on how many debts you have, how much debt you have, and how much premium you can afford to do without becoming a problem. After we get you out of debt, then we've entered the accumulation phase. For those people that do not have any debt, no house, no mortgage, no student loans, no credit cards, no personal loans, no car loans, no nada. For those people, you're starting off at the accumulation phase. So I've heard people say, oh, I don't know any debt. I don't need that. Well, yeah, you do. Why? Well, because I'm going to put your retirement on steroids with this vehicle. We're going to make all that money that you were throwing into that 401k that you've probably lost about 20 or 28% this year so far. We're going to make it so you haven't lost anything. Truth be told, when I'm looking at this stuff right now, if you had invested the same money before the crash recently, the recent crash, you've lost 28 to 30% in the crash. In this system, you'd be on track to about 8% gain. You wouldn't have lost a dime, okay? Because it's not invested in the market. The accumulation net phase finishes when you're ready to start taking money out. That's the distribution phase. What does that mean? That means you take loans. You take income from it if you want. You do whatever you want. It's your money. You can take as much or as little as you want to. The IRS can't tell you how much to take or when you can take it. The IRS can't tax you. A judge can't order you to liquidate the account. It's immune from torts. Nobody can sue you and take it. So there's 100 things good about it. The only thing that I've seen that's bad about it is, if you want to call it bad, it grows cash fast. And if you've heard those stories about people winning the lottery and how those people are sometimes completely void of cash or they're broke inside of a year or two, it's the same kind of thing here. If you're not accustomed to managing large sums of money, it can become very tempting to go out and buy that emergency jet ski or that emergency boat, right? So this is why you have to be careful. This is why you have to make sure that you're doing things correctly, following the plan, making sure you're using the money for needs, true needs, not wants, until you get to that distribution phase. And then go crazy. It's your stuff. Do what you want to do with it. Have a good time. Okay? Moving on. I told you this isn't an old concept. It's been around for a long time. And these are some people that have done it. Walt Disney did it over and over and over again when he built the Disney properties. Doris Christopher did it when she started Pampered Chef on a very much smaller scale, but she still used this. Ray Kroc did this multiple times as he was opening multiple McDonald's across the country. And lastly, Warren Buffett. I'm a Warren Buffett fan. I study Warren Buffett. I've studied his trading methods and all those things. And this is one thing that he's used from day one. From the very first time he left Columbia, started out on his own, became a trader wasn't a trader. He was an investment evaluator. And then he started doing this on his own when he created Berkshire Hathaway. He's always used vehicles like this. He understands life insurance. He understands insurance in general. One of Berkshire Hathaway's biggest purchases was Geico. So just FYI, the guy understands insurance. He believes in it. He uses it. And I don't know that you're going to be able to point to anybody else who's used it less effectively than him in this country. So this is not new. It's something that's been around for a long time. It is tried and true, tested. Certainly these people here that you see on your screen are people that have tested and used it. The only difference is previously there were pitfalls, and previously you had to have a whole lot of money to be able to do this. So you had to be able to go to an insurance company, meet with a private insurance broker who is able to talk to one of the many carriers out there that would be willing to create a private insurance policy for you and spend millions of dollars funding it, and then they'll allow you to borrow money. And so what Symmetry's done is we've created a solution where what was mostly only available to the richest people in the country is now available to the mass populace. And this is why we're doing debt-free life, because we've declared war on debt, and we've declared war on all the other things that the debt causes as well. So what do we say? This is what I've been saying since the beginning. We're going to help you spend money more efficiently simply by redirecting the money that you're spending wrongly. How? Example I used as a credit card earlier. Your bill's $75 minimum. You're paying $125. That's $50 more than you're paying. We're going to build a cash value um, in the whole life policy. We're also going to build paid up addition value, which is we're going to use like cash. What is a paid up addition? In a nutshell, a paid up addition is a life insurance policy that has a permanent value that you never have to pay for again once it's issued. And every time you make a premium payment with this plan, you're buying additional paid up additions. That means every time you make a life insurance premium payment, you're building more cash value. I'll show you that in just a minute. The next item there, borrow from the policy's cash value with no penalty of tax. Yep, that's what we're talking about. It's all tax exempt. And we can thank the IRS for that because of IRS tax code 7702. Repay the loans. You can repay the loans either by making your life insurance premium payments, by making extra payments if you want to, letting the snowball pay it off, or if you don't want to do any of that, you can let the dividend pay off your loan for you over time as well. This is one of the things I love, one of these last two things, the finance future purchases. So we all know that life happens. Things are going to happen. I don't know what's going to happen that's going to change your plan. All I know is that once we execute one of these plans and start it, we have to be flexible because it's going to change. Things are going to change. Maybe you have another child. Maybe your child needs braces. Maybe your child is ready to go to college. I don't know. But the point is that this plan allows us the flexibility to address those issues as they come up. Okay. So you can plan for the unexpected. We did with that emergency fund, and you can plan for the unexpected simply by paying your premium. Both ways are built into the system for you, and you're covered. Last thing, don't forget, at its core, what debt-free life is a life insurance policy. Okay. At its core is a life insurance policy. It's a large one and it grows over time. It gets bigger and bigger. But the point is, when you actually get that call from the big man upstairs, you're not going to be leaving your family in the dust. They're going to be set. This policy will, when you're structured correctly, will cover all of your debt. So if you take your policy out on day one and you get hit by a car on the next day, you're covered. Your family's covered. All your debt is gone. If you go 20 years in the plan, then all your debt's gone and you have a huge chunk of change. And we'll talk about that in just a minute too. So these are some of the folks that we've worked with in the past. 84,000, 100,000, 73,000. That's the amount of interest that they paid off. That's great. And those are normal numbers for traditional blue collar America. And some of the folks that I've been working with, their debt's a little bit higher than that. And I'm looking at, in some cases, over $1 million in debt. But it works for everybody at every level. Whether you have zero debt, a little bit of debt like the $84,000 or $73,000 family there, or a lot of debt like millions of dollars, or a whole lot of debt. For example, if you're here because someone referred you for a business debt-free life plan, and one of the folks I've worked with there was, I think, 6.2 million in debt, and we were able to use that debt as leverage and create a $40 million retirement for them. And they're also going to be out of debt in 2.3 years. So these are things that this stuff can do for you. Improving the cash flow. There's no way your cash flow is not going to be increased. It works for everybody. And then the tax favored income, again, this is the most favorable tax-wise of all incomes. So how does it work? So let's talk about how you do things right now. So this is how you currently spend money. You make your money. That means that you've gone out, worked your job, whether your salary, hourly, whatever, doesn't matter. You made the money. You take that money and you deposit it into your bank, whatever you bank with. Bank of America, Wells Fargo, Citibank, whoever, it doesn't matter. So you put the money in that bank. And that bank, as your money is sitting in there, that bank is making money with your money every night. They're lending it out at the federal funds rate or higher. The average bank is going to lend every dollar you put into your bank 7 times before you actually use it. They're going to earn anywhere from 1% to 24% with that dollar, and they're going to give you nothing, most likely. Sometimes you do have those checking accounts that'll pay you a small fee, like 0.25% or 0.5%. Rest assured, they're making 25, 50, even 100 times more than what they're paying you back with their money. Because at the end of the day, what does a bank own? Bank doesn't own anything. Bank just has your money and you allow them to use it. So at the end, you write a check to pay your debt, or you instruct the bank to pay your debt with bill pay or whatever you use, and then your debt is paid, and then that money that you use to pay that debt becomes their money. So in the beginning, it's your money. When it's with the bank, it's your money. And then when you pay that debt, it's their money. And in the process, your money didn't do anything for you other than pay the debt. You did not make your money work for you. And that's the secret. If you want to talk about people who are the wealthiest in this nation, that's what they do. They allow themselves to put their money in a place where the money works for them. So it's not just me working, it's their money working as well. So in this situation, you're using your dollar one time. Your bank's using it 7 times. And in the end, your money's gone. And all you got to show for it is your debt is paid off. What if there was a better way? And that's what debt-free life is. This is how we do it. This is how we're going to show you how to do it. And hopefully craft a solution for you that's going to put you on that track, which I'm going to show you some real numbers from real people in just a minute. So in this system, you're doing the same thing. You still make your money, still work your job, get your salary, whatever. And oh, by the way, it does not take a whole lot of money to execute one of these plans. I've done them as cheaply as $151 a month, and it works like a charm. And that $151 a month plan that I did, it still paid off a mortgage in 9.2 years, plus another $30,000 of the debt. It works, okay? So back to the example here. You make your money as income gets deposited into your checking account. And here's where our system differs. So rather than leaving all that money that you made, you're going to make a life insurance premium payment. And you're going to take that money out of your checking account and you're going to place it up there and pay for your life insurance premium, which is your whole life policy. Remember I said at the very beginning of this, all debt-free life is a whole life insurance policy with some exotic riders. So the whole life policy is the base policy. Whole life policies by default will build cash value over time. Eventually they do what's called endowing, which means you've paid enough money into it that you don't ever have to pay for it again. And that's something that we as brokers and underwriters can do for you. We can actually structure that based on when you tell us you want to retire. So I did one yesterday for a 49-year-old that's going to retire at 65. So in 16 years, that individual is going to stop paying the premium for this plan. They're going to be completely debt free and they're going to have about $800,000 in their account. Awesome, right? Right. I think so. I already talked about some riders. So here's the first rider. The first rider that we have to have on this policy is called a term rider. Term riders, if you're probably familiar with life insurance, is nothing more than an agreement between the life insurance carrier, a contract, if you will, that they're going to insure your life for a period of time as long as you agree to pay a certain premium. And then based on the size of the premium, they're going to pay a death benefit to your family members, whoever the beneficiary is. That's not why we have the term life in this case. In this case, one of the key components here, remember I mentioned this earlier, IRS tax code 7702. That says 2 critical things for debt-free life. The first thing, it says that all monies derived from a life insurance policy are tax exempt. Okay, let me say that again. All money derived from a life insurance policy is tax exempt. So that's great. However, they also protect themselves and they say if the life insurance policy has too much cash value that exceeds the life insurance value, that policy is no longer life insurance. And it has entered the realm of what we call a modified endowment contract. Okay, as a modified endowment contract, the game is over. It's all taxable. So the reason why we put that term life rider on there, and it's not permanent, it's just there for maybe 10 years, maybe 20, depending on what you need. It's there so that we can increase the amount of life insurance, increase that umbrella so that we can grow the cash underneath it, so that when the time finally comes that we don't need that umbrella anymore, where the cash is still less than the total life insurance value, but we can grow at a rate that we're okay with. That's why it's there. So the IRS can't say, wait a minute, stop, pay us tax. We're avoiding that potential legally. This is how they say to do it, okay? And the last thing that one single payment coming out of your checking account does when it goes up and pays that whole life policy, it's getting split into 3 parts, right? It's getting split into whole life, term life, and the last part, which is a paid up addition. And that's something I mentioned earlier also. What a paid up addition is additional life insurance, which is paid up. What does that mean? It means you don't have to pay for it anymore. So here's an example. If I buy a $1,000 paid up edition life insurance policy today, I pay for it. As soon as the carrier receives my premium, that life insurance policy is worth $1,000. Tomorrow, that life insurance policy is worth $1,000. 10 years from now, it's worth $1,000. If I live 50 years from now, it's still worth $1,000. So that life insurance policy is paid up and it's paid up until I die. And when I die, it's going to pay out $1,000 to whomever my beneficiary is. Okay. So that's a critical concept here, the paid up additions. So when I'm paying my premiums up into this bank, I'm building cash value in the whole life. That's the hidden part. That's an emergency fund. I'm buying additional paid up additions with every premium. Somewhere between 60 and 70% of every premium is buying additional paid up life insurance. And so my paid up addition life insurance is growing on the right side of your screen. The cash value of my whole life is growing on the left side of your screen. And that term life is in the middle, creating that umbrella so that I can grow without having the risk of the IRS saying this is now taxable. So what did I do? I moved the ability for that bank, which is my checking account, to make money every night with my money and not pay me any of it. I moved it up here into what is now my bank. I've moved my money into my bank simply by making my life insurance payment. I've created my own very own DFL bank. That's great. That's how we're building. That's where the money's going. That's how the money gets there. So what do you do with the money? So this is again that conversation we talked about earlier. Let's assume you had $10,000 into your bank and you wanted to take a loan of $9,500 because you want to pay off a debt. So I take that loan as a carrier loan. So my $10,000 is still sitting in my DFL bank. It hasn't gone anywhere. It's still sitting there, still earning that guaranteed 4% interest compounded monthly, still getting paid that annual dividend. But I now have a loan of $9,500 out against the $10,000 value. No big deal. I say, hey, bank, that money I just deposited, that $9,500 that I took out of my DFL bank, that I just put into my Wells Fargo bank, Wells Fargo, pay my debt. So Wells Fargo sends that $9,500 on to pay my debt, and that money became their money. But where's your money? Your money is still sitting in your bank. You did not use your money to pay that debt. You used the carrier's money to pay that debt. Yes, you have a loan. Yes, it is using the collateral of your paid up additions, but that doesn't affect the interest rate that you're receiving. And it only affects your dividend if you don't pay off that loan within a year. And if it does affect your dividend, it's probably not that big of a deal. You're still getting the dividend and it's still going to be paying down that debt over time anyway. Okay. Certainly in the first year or two of any one of these plans, missing out or not receiving the complete dividend is pretty much irrelevant. It's not going to affect the long-term performance of this plan. So the end result is here. If you remember in the previous example, your money became their money. And in this example, your money stays your money. The carrier's money becomes their money. And oh, by the way, the carrier is agreeing to pay you an interest rate where when you look at the guaranteed interest rate, the guaranteed 4% plus the dividend, most of the time, the amount of interest you're receiving on your money exceeds the loan interest rate. So even though you may have a loan against all the cash value of your paid up additions, you're still going to be gaining every year. Okay. So that's the how the money works, how it gets from A to B, how the plan works, where the money comes from, how you use and leverage your money without ever using your money. This is the debt-free life method. It's been around in different iterations for a while, a long time in different solutions previously unavailable to us, but now it's available to all of us. I would be hypocritical if I were to be recommending this product and not having done one myself. I've done one myself. I've done two myself. Actually, I've done just about every family member I have because this is a brilliant solution. Even if you're looking at, for example, an 18-year-old who doesn't really have any debt, start them off. That 18-year-old with a very small plan like this, you're talking millions of dollars at retirement. You're also talking about hundreds of thousands of dollars in their 40s and their 50s. You're talking tens of thousands of dollars when they get ready to start buying their house and need a down payment. And we all know the old The old adage that the golden rule, right? The man with the gold makes the rules. So this is the same thing. The person with the cash makes the rules. Walk into a car dealership, the car's $30,000, show up and say, I'm going to pay you cash, not knowing that you're pulling the cash out of your DFL bank. And they say, okay, I'll pay cash. Great. And I'm going to pay you $24,000. I want $6,000 off. Are they going to hem and haw? No. They're going to go in the back, grab the manager, get some paperwork, come out, and they're going to sell you that $30,000 car for $24,000, no questions asked. Same thing is true when buying real estate. Walk up, make a direct, an earnest money deposit on a piece of real estate. Maybe you write $1,000 normally, maybe $2,000. Go in and write a $20,000 check. See how much they'll come down on that home price. See how eager they're going to be to sign. So this gives you options. This gives you control. All right, so let's move on. I'm going to show you how this works for a standard family. So this is a family that I worked with about 4 months ago. Nice folks. Nothing abnormal with these folks other than, yes, they had both been previously divorced and they had 2 houses. So in this case, there's a primary residence, there's a secondary residence. Other than that, these are standard debts. One of the 2 parties was a full-time student, now teaches in college, but she's got a tremendous amount of student loans. And the other individual owns and runs his own business where it doesn't really matter what he does for a living, but he has fairly good income and he's fairly young. So in this scenario, as a family, they've got a lot of debt. See that column over there to the right, the payments column? $767,000. Is that how much debt they have? Yep, that's how much debt they have. It's not how much they actually owe. They only owe $584,000, but their true debt is $767,000. That's because that's the interest that they've got. And on their current situation, because of the student loans, it's going to be 40 years for this family to get out of debt, because those student loans, some of them are deferred and they're growing like weeds, and it is what it is. So this is where they're at. Their $584,000 is actually $767,000 in debt. Now, in 40 years, they'll be debt-free. They won't owe a dime to anybody. They'll have 100% equity in 2 houses, and that's it. So with the debt-free life system, using the same money that they are currently spending, remember, all we're doing here, we're not creating a new bill. We're just changing the way you spend money. We're spending the money more efficiently. Instead of spending $200 on a credit card with a $50 minimum payment, we're only sending in the $50, and we're putting that other $150 up into your private bank, into your DFL bank. That's going to grow with interest over time. Okay. This is where we got them. With our plan, we got them out of debt, not in 40 years, in 7.8 years. We saved over $70,000 in interest. Where'd that money go? They were going to spend it anyway. So where'd that money go? That went right into their pocket, which actually what happens is it goes right into their bank. So that's $70,000 over the course of the next 7.8 years, right? That is going to be going into their bank that we're going to be using as fuel for the engine, the DFL engine, if you will. Pay attention to that bottom line. That's the cost for that family not to have done this plan. So over 40 years, they would have paid off all their debt, had 2 houses with 100% equity, but that's it. With this plan, because we took everything that they owed and got it all paid off in 7.8 years, saved them $70,000 in interest, that means all that other money that they would have been spending on debt service is now being spent on retirement. And this plan created a $4.8 million retirement account for them. Moreover, that next line, $5.9 million, that's the total value of this account with cash value and death benefit. As the death benefit, I told you, it grows, builds up over time, right? Here's how it worked for them. Every one of these yellow lines is a year where at least one debt had been paid off. In this scenario, they had a bunch of debts. They had about 15 or 16 debts. And that's something I want you guys to pay attention to. This plan works for everybody, okay? But it works better for people with more debts, plural. The amount of debt is irrelevant. So if you have two people with $100,000 of debt and one person's got 6 debts, 2 credit cards, 2 car payments, a student loan, and a house, and the other person has only one debt, $100,000, the person with the multiple debts is going to pay their debt off faster because the debts snowball. Because remember, this is infinite banking coupled with debt snowballing, true debt snowballing. Okay. So in this scenario, the debt snowball, we're making larger and larger payments every year, taking loans, paying them off, taking loans, paying them off. And that column over at the right, that's the cash value of the plan. So at the end of year 2, there's over $40,000 sitting in this plan. The end of year 3, there's only $29,000. But what happened? They paid off $58,000 worth of debt that year. It's huge. In year 4, there's not enough cash built up the way that we illustrated here to pay off another debt. And then in year 5, that $96,000, that's their second house. They pay off their second house, and they still have $61,000 left in their account. Year 6, they pay off another $68,000. That's the rest of the wife's 40-year student loan. She owed $99,000. In 6 years, we're paying all of it off, and they are debt-free with the exception of their primary residence. And then we get into year 7.8, which is referenced here as year 8, and then we're paying off $117,000. That's that middle column loaned from CV, and they are completely debt-free and still have $75,000 sitting in their account. This is great. It works like a charm, right? Something else I want to show you. These people wanted to retire. The husband says he's going to work forever. But I said, no, look, we have to have a retirement date. When are you going to retire? So he said, all right, well, I'll probably stop when I'm 75. But his business is going to keep running. He's just going to stop working. So at 75, he retires. At 76, he hasn't made any premium payments. And our plan has over $5 million in it. At 77, he still hasn't made any premium payments. And our plan now has over $5.25 million. That means this plan is growing just through the effect of compound interest and dividend over $200,000 a year. This is not abnormal when I'm looking at these accounts, looking at these plans. So now let me show you a much smaller version of this. And this is going to be for a student. So a student isn't going to have a house yet. Are they going to have debt? You betcha. So this is a real live person that I worked with a couple months ago. So this individual has 4 student loans. That's the Parent Plus, unsubordinated loans, PP2, PP1. They also have a couple other loans that they're going to roll into here, which is a hospital bill. They've got a car payment, and they've got a vet bill for one of their cats. So her total debt right now at 23 years old is $85,000. See that up there, the total interest paid? Over time, because again, these are student loans and some of them are being deferred right now, she's going to pay $177,000. Doesn't sound like a lot, but she's going to pay $91,000 in interest. Okay, and this is a very inexpensive plan. This particular client is a waitress. She doesn't make a lot of money, but she believes in this. She sees this. She understands this. So she's actually funding this with $350 a month. Okay, this is a $350 a month plan for a 23-year-old. Awesome. So we got her out of debt in 9.7 years. We saved $64,000 of interest, which is going right into her plan, and it's going to become a retirement solution for her. So this little 23-year-old who said she wanted to retire at 65, in 40 years, when she's 63, she'll have $603,000 in here. Moreover, we didn't wait until she was 65 to retire. We got her retired at 55, 10 years early. And at 10 years early, she's going to have $409,000 in here. And this plan at that point is growing $22,000 a year just from tax, just from interest, guaranteed interest and dividend. So basically what we did is give her a $22,000 a year income or pension, if you will, for the rest of her life. And oh, by the way, if all she ever does is take that $22,000, it doesn't defeat the plan. The plan still grows every year because every time the dividend comes in, it's paying down the loan, but the 4% interest is hitting it every year as well. The plan still grows and grows and grows and grows and grows. And when she turns 65, where she wanted to retire, she'll have $658,000 worth of cash sitting in an account. Think she can retire with that? Think that's a little bit better than that $60,000 that most Americans are going to do. And also, by the way, this plan assumes that she's never going to make any more money than she's making right now. This plan assumes that she's never going to get a raise. This plan assumes that she's not going to get that master's, and she's currently in the master's program, and she's not going to go out and back and get her doctorate, which I know she will. So this is, again, we can't project those things, but I can make assumptions. I'm not making any assumptions. What I'm showing you here is the real math. And that middle column, that savings balance column over there on the right side, what is that? Well, I told you earlier, that the term policy creates this umbrella. Well, this particular plan, and a lot of them do this, the plan is growing too fast. So it cannot hold all the cash that this plan is creating. So that is actually a second bank that she would create, or that's, as we're saying right here, a savings balance. Couple things I want to show you. I want to speak about these illustrations. First off, the only thing we're illustrating here is the 4% guaranteed return. Second thing, we are not illustrating any dividend. And the third thing, the assumption that we're making on that savings balance column is that you found a really, really nice bank that's going to pay you 2% return on your savings account. Good luck. Okay. So that's why I say that's a second bank, because when I set these up for folks, I always set up a second bank, simply because I'm not going to want you to put your cash in a savings account and earn realistically 0.5% when I can put it into my vehicle and earn 4% plus a dividend. Okay. So a couple other things I want to talk about real quick. And where you are right now, you guys have been shown an opportunity about debt-free life. You've been given an example, a couple of them, of how it works. I have presented this to 49 families in the last 8 months. It has been appropriate for 48 of them. Okay. We've executed 47 plans so far. All right. So will this work for you? The only reason I can think of that this wouldn't work for you is if you do not currently make your debt service. What does that mean? That means you make $10,000 a month, but you have $12,000 a month in bills. So if you are currently able to pay your bills, make your debt service, make your debt payments, this will work for you. And if you're one of those people that the only thing you do is pay the minimums, it will still work for you, because eventually that snowball will start. And when that snowball starts, it's I like to think of one of my favorite Christmas cartoons is the Grinch Who Stole Christmas, and there's that little dog that's pulling that big sleigh, and they got the antler tied onto the head of the dog, and the dog starts running down the hill, and all of a sudden he trips and he starts to roll and becomes that big giant snowball. That's what debt-free life will do to your debt if you follow the plan that your agent, broker, underwriter can set up for you. All right, I'm going to go back into something I did last week real quick, and I'm going to show you one more thing. Bear with me just a second. And I want to talk to you. I did some additional mortgage chunking evaluations over the weekend. Came up with some additional anecdotes that I want to show you guys. And so let's go through that. Okay. Okay. So mortgage chunking is, again, this is not anything new. This has been around for a long time. The concept has been a long time. And don't forget, when I say mortgage chunking, I'm just talking about chunking in general. It is not, why is this not working? Never mind. It's not a new concept. It is something that we've used over and over again, but the idea behind mortgage chunking can be applied to any debt at all. So what does that mean? If you've got a credit card, paying $1,000 a month on that credit card is chunking that thing down big time. If you've got a car loan, you got a $250 a month car loan payment, but you're sending them $1,000 a month that you're taking as loans from your DFL, chunking. It works for everybody. Okay. And it works on every debt. So you don't have to wait to do mortgage chunking just on your mortgage. It will work on any kind of debt that you have. Oh, good. We're getting close anyway. So if you've seen me do these before, you've seen my mortgage chunking component, and that's great. The one concept I want you to remember and want you to think about is that the chunking piece, like I just said, will be usable on any debt if it's appropriate. Do not take a $200 loan so that you can mortgage chunk a $700 debt. Don't do it. Okay. It's not worth the hassle. It's not worth the extra time. But if you've got a couple $1,000s and you've got it's going to be, when you look at the plans, for example, your next debt to pay off may not be paid maybe until middle of next year. Okay. Once you get going into these plans and you've paid off all the smaller debts and you're into the larger debts, the student loans and the car payments and things like that, that's when it's appropriate to start chunking. Otherwise, it's going to be kind of a headache for you to go through the process of taking out the loan paperwork and getting it from the carrier and doing all that stuff, and then going through and talking to your broker, agent, underwriter, and having them write another illustration for you to demonstrate what your mortgage chunk just did for you, because you're going to want to know. Okay. I did just, I'm going to give you some of the statistics that I just ran though, looking at mortgage chunking. And what I did was looked at the effect of mortgage chunk on mortgage chunking, just mortgages, when you're able to do it. So that means basically every time you get up to $5,000 or $10,000 in your account, pull a loan, throw it at the mortgage. When you do that, it's going to escalate the illustrations that we use here by about 10.9%. So it's going to show up about 10.9% faster. So the one I did and ran the evaluation on last night, it went from 6.2 years complete debt elimination down to 6.1 years. So it cut about a half a year off. Doesn't sound like a lot, but that's still about 10% of the time. We're talking about going from 70 some odd months down to 60 some months. Okay, so that's one of the other things about chunking. So at this point, I'm gonna be quiet for a second, and if you have a question, I'm going to answer the ones that are in chat first, and then we'll open it up for anybody else. First question: is the best way to pay off a big mortgage chunking so that you can pay back the loan before the 12 months are up? Good question. It's actually two questions though. The reality is the best part to pay off any debt, if it's large enough and appropriate for chunking, is to chunk it. But we can't demonstrate or illustrate the effect of chunking in the future. We have to do it every time you make the chunk, then we do a reevaluation, plug in the new numbers, run a DFL illustration again, and then we're able to see what it did for you. Always, chunking is going to work faster than just doing the standard DFL method. Second part of that question: pay back before the 12 months are up. As I was mentioning earlier, the dividends that are paid in the first couple of years, there's a couple of factors. It's not just how much cash you have in the account. Okay, it's how young is the individual, what kind of a risk is the individual that's the insured, what kind of premium is being paid, what kind of cash is being built up. All those are factors. So in the very beginning stages, the biggest factor is always going to be the cash value of the account, whether it's the PUA value or the cash value in the whole life piece. That's always going to be the biggest concern. But the point is, year one, the dividend's nothing. It's not worth it. So for me, all the folks that I work with, I'm telling them to make the thing work the best. It's kind of you don't think about it this way. And actually I went through Mutual Trust and sat on there with their underwriters for about 2 hours explaining to them what I was doing. And they said, oh yeah, that is a better way. You take and maximize the PUA. That's the critical part. So if you're going on a mortgage chunk, that's fine, but maximize the PUA, because as soon as you maximize the PUA, because that 4% guaranteed interest, it's getting compounded monthly. So the sooner you get a full bank where that 4% can churn and burn every month on it, the better off you're going to be in the long run at the end of that year. So what I do with all my people is we go in, I have them structure every payment is going to buy PUA, period. PUA. I'm not paying off a loan. I'll let the dividend pay off the loan. I'm buying PUA until I hit that ceiling. And then I switch it. I take an immediate loan, pay off as much of everything that I can. And then now I'm doing nothing but paying back that loan. So the loan, my loan capacity started here took the debt, it's down to here. And now as I'm paying back my loan, it's rising up, rising up, rising up. And then I'm doing the same thing. I'm maximizing. But here's the trick. The trick is you want to maximize it out in the beginning or as close to the beginning of your anniversary year every year. So maximize it out as soon as you can, and then use it, take the loan, pay the debt, pay off that loan until the next anniversary year, and then stop paying back the loan, maximize the PUA again so you can get more money in there that's earning that 4%. And in the first couple years, it's irrelevant whether or not we miss our dividend, because we're not going to miss it. We're still going to get a dividend. We're just not going to get the full dividend. And it's not that the amount of money you're going to be missing, $300, $500, $1,000, it's nothing compared to the amount of interest you'd be missing if you don't do it the way I just showed you. So again, answering that first question, is it critical to pay it off in the first 12 months? Not in the first couple of years. And the reality is once you get the snowball rolling, you won't have a choice but to pay it off within 12 months after the snowball is rolling, because you're going to be putting so much money into this thing that you will not be able to not pay off the debt and then maximize your PUA. And that's why that money is going to that grade column, the savings column that we showed you. That's what's happening there. Okay. From Jamie Satterfield. Yes, I agree with you, sir. Bald is beautiful. Let's see. Haha. Mr. DeCaesar, business debt. Absolutely. I do a lot of these for business owners. There's a different concept that you have to use, a different strategy that you use, and it depends on what the nature of the business is. And so I did this for a trucking company where before they were purchasing one semi about every 2 years, and now they're purchasing 2 semis a year for their trucking company, simply by running all the money into it. And he's actually set up 3 separate DFLs. One of them's for the trucking company for purchasing of vehicles. One of them's a personal DFL for him and his wife. That was actually the illustration I showed you earlier. The family, that's them. And the third DFL that he has, and this is a business concept. There's for a company that has a fleet, there's a standard metric that you can use of how much maintenance they're going to have to do, how much they're going to have to pay to get the maintenance done, how much taxes they're going to have to pay, and all that stuff. So what they're doing here is they're taking all that money and throwing it up into that vehicle, and they're pulling it out as a loan when they need to pay the taxes. So what's happening here is they're making their tax money work for them, and they're making their cost of maintenance work for them. This works very, very well with people who are house flippers. So if they're well financed to begin with, going out and spending $50,000 buying a house doesn't make any sense when I can put $50,000 into a bank and then pull out 50 from the bank and go buy the house. And if I'm going to spend $20,000 renovating that house, going to Home Depot, Lowe's, whatever, take the $20,000, throw it up in here, and then take the loans out of this, put it on the Home Depot credit card, whatever, pay off the credit card every month. Okay, so that's another concept for businesses. It works like a charm. Tax exempt status. There is a way that these vehicles can be structured such that business owners that are employees of their business can take this as a write-off. That's a CPA question. I'm not going to tell you how to do it. I know how to do it, but I'm not going to tell you because I don't have a CPA. So you can do it. You have to get with your CPA. Your CPA understands and knows how to do it. Let's see. Are people depositing income? So the question is, are people depositing income into the policy instead of their checking account? Yes, kind of. So here's the kind of. I have an Air Force general that I'm working with, and what he does is he has about $4,800 a month of expenses. So he deposits $7,500 a month. He makes the money, goes into his bank, writes a check to pay his life insurance premium, takes a loan of $4,800 out of the policy, back into his bank account, pays all of his monthly debts, his car payments, his house payments, food, power bill, the whole 9 yards. So basically, he's making all that work for him in perpetuity rather than spending it and having it be gone. Let's see. Will this work for clients over 60? Yes. I did 2 last week for clients over 60. One was 65 and one was 73. if you're over 70 years old, there's only one carrier you can use, which is Foresters, simply because they're the only carrier that will write a PUA rider for someone over 70. They'll write it up to age 75. Lafayette and Mutual Trust will write up to age 70. Let's see what else. I see that you get money in your clones. Oh, how do you take your money out of this for retirement? It's simple. You take a loan. So remember, when I'm looking at some of these illustrations where I showed for the young girl, she was making $22,000 a year. So she takes a loan for $22,000 every year. The interest on it, and the thing grows by 22,000 the next year. So she takes another 22,000. The dividends coming in, paying off that, because remember those illustrations I showed you earlier, I didn't illustrate the dividend. So the dividend is extra on top of that. All I illustrated was the 4%. Okay. So the dividend's going to pay off the loans. You're never going to be able to borrow 100% of the money that's in there, and the money's always going to be growing. So yes, you'll be able to take it as a loan every year. This is the same way that when you look at indexed universal life policies that have the lifetime income benefit rider on them, it's the same process. Let's see. If you chunk, the actual monthly payment due to the debt doesn't change. So mortgage chunking. So yeah, anytime we're doing a chunk, whether it's a mortgage chunk or anything like that, the amount of money that we're paying is in addition to whatever our monthly payment could be, right? If you want, you could, this is where you have control. You can skip that monthly payment and say, okay, I'm sending you a check for $10,000, take my minimum premium and put the rest of it to PUA. You can do that if you want. But what I do is I know that you're accustomed to paying a certain debt. I know that you're accustomed to paying a certain amount of money every month. So what I'm going to do is I'm going to instruct you to continue paying that every month. Get used to it. Doesn't change. Remember, I'm not creating an additional bill for you. I'm just changing the way you're spending money. Okay. So you're going to chunk it, pull the money out, chunk it, pay off the debt. Debt's going to be gone. And then you're going to use that money that you were paying. It's going to be a snowball. But in all instances, whenever I do these illustrations, I'm always suggesting that you continue to make your minimum payments every month until they're paid off. Let's see, is this better than an index universal life policy? That's personal preference, and I would say hands down yes, because an index universal life policy is going to have a component that's going to be driven by the market. If it's indexed, it's got to be indexed to S&P 500, Janus 250, whatever, Barclays, and all those indices are going to perform or not perform based on the relative strength of the stock market. So your return in an IUL can be limited and will be limited in times when the market doesn't perform. In our situation, we don't care whether the market goes up, down, or sideways. We're always going to make our guaranteed 4%, and we're always going to make a dividend. Incidentally, the three carriers that we use here at Symmetry, all three of them have been in business over 100 years. None of them have never, they've always paid a dividend every year they've been in business. That means they've been through, that's my favorite things to say, they've been through every good president, every bad president, every war, every policing action, every recession, every depression, every pandemic that this country's been through, and they have still paid a dividend. Okay. So one of the questions here's, if you think about this as compared to like a 401k, how safe, the safety of it. So it's not, so, from my perspective, it's not. The 401k isn't safe when it comes compared to this. And if you look at over time, how these things perform, I mentioned this earlier, if you run a guaranteed 4% interest plus a minimal dividend, as compared to the actual market performance of the market over the last 20 years, 17 years out of 20 years, this vehicle is going to outperform the 401k, IRA, whatever you've got as a retirement solution. And in the end, when you take into account the amount of taxes you're going to have to pay when you pull that money out, this way outshines it. So is this better than IUL? Sorry, I got off track. I apologize. Yes, it is better than IUL because you're not subject to market conditions. You're actually insulated from market conditions. Mr. Deutsch, let's say a client is a lump sum, want to roll into this. Can they pay the annual payment, take a loan off? Yeah, great. So this is one of the things we talked about a little bit earlier. I think Lump sums. You can, as the broker underwriter, one of the things that you can do is you can schedule a single premium lump sum to come in at a certain point. You will have to modify the size of the term policy, and you'll also have to pay very close attention to what the first year snowball amount's going to be, so that you can make sure there's enough room to capture that single premium as well as the snowball. And then you can go ahead and do what Tom was asking here. Can you immediately turn around? Yes. And I just did this a couple weeks ago with one of my older clients, 63-year-old. She had $32,000 sitting in an old IRA. We were talking about doing an annuity with it, but we actually decided that it would be better for her to actually pull that $32,000 now, put it into a DFL plan, and then immediately pull out $31,000 of her, actually it was $30,500, and pay off all of her debt with the exception of her house. So basically she became debt free overnight using an old IRA 401k. She didn't lose the money. It's just in a different account, earning a guaranteed interest rate that's not subject to market condition, and she'll never lose money with it. So awesome, right? Checked all those boxes. Okay. Next. What if you're in your 50s and you have less than 5,000 in debt? Then congratulations. You're on your way to step 2 of this process, which is the accumulation phase. So basically you're just looking at this as a retirement vehicle, and that 5,000 in debt, hopefully it's multiple debts, and you'll be able to say 20 bucks here, 50 bucks there, 75 bucks here, whatever, because the multiple debts that you have, the faster your debt snowball is going to work, and that's going to grow your retirement better. Let's see. If the client had a few credit cards they're close to paying off when they're setting this up, what's the advantage to including them in the plan? Absolutely, under no circumstances should you pull the trigger and pay those credit cards off unless you're willing to go ahead and say, okay, well, I was paying that snowball, I was paying that before, I'll go ahead and add that into my snowball amount. Okay, so it's okay if you want to go ahead and pay it off. Just realize, you think of it like this. I don't want to get too deeply into trading, but in stock trading, you can actually trade a stock without owning it. It's called short selling. So in this case, you can actually plan on using your debt-free life bank without actually having it in place. How does that work? So consider that you took that $500 to pay those credit cards off out of your checking account, right? But think of it like this. Think of it that you took it out of your DFL bank. So when your DFL bank gets set up and gets rolling, put that $500 back in that DFL bank. And that way you'll have the advantage of that credit card's paid off. Great. But now you're making that $500 that you've spent and is gone forever. You're making it work for yourself forever with the guaranteed 4% interest rate plus a dividend. I don't know if Patrick and Joseph are brothers. What are the 3 carriers? Mutual Trust, Lafayette Life, and Foresters. Mary, there's a question here. Are you single? What types of businesses are ideal for DFL? Any business that's marginally capitalized, has debt, and has an owner that's willing to have an open mind about things. So I have yet, I did one of these for a law firm, and they like it because they had used a home equity line of credit against one of the partners' homes to be able to pull cash out. I mean, the legal industry has seasons. It comes and goes, and they make money. And then especially if they're in the tort business doing lawsuits and stuff like that, they have to wait a long time to get paid. So when they pay themselves a salary, it's usually from an account that is a home equity line of credit, or basically a line of credit that they can borrow from a bank. So what they did is they set one of these up as their own personal line of credit. So they funded it with $100,000 with a single premium, and now they're pulling out money when they need to, and they pay it back on a monthly basis. Let's see. Okay.
Hey, Scott.
Yes, go ahead.
I have a question that's really hard to type in.
Okay.
And at first, I want to apologize to Mary. I meant that to be kind of lighthearted. I hope that didn't insult her. But
Mary, Tom's a jokester. If you didn't know
that's pretty cool.
He's always joking around.
I'm joking around. Also, I'm the Patrick and Joseph. They're right next to each other on my screen, and I swear they're like twins.
Yep.
So my son hit me with with a couple of he's an engineer, so he grilled the hell out of me on this.
Awesome.
And I sat there, and as I'm answering his questions, I'm like, thank God for Scott Forehand. I've listened to this guy a bunch of times, and I actually can answer these questions pretty well. So here's the first question. His fiance is a nurse. She's graduated, but she's taking additional classes. She's paying $1,700 a month out of pocket per semester to go to class. She's got a small amount of debt, maybe $25,000 left over. We're in the process of putting her in a DFL, and I didn't know this was going on. And he says, well, would it make sense for us to take a loan and then run her $1,700 through the DFL? And my answer to that was yes. It defers the payments, but it doesn't defer the interest. The interest is going to be about 4%. We got into the whole, well, this is a 5% versus a 4%. Give me your thoughts on that real quick.
Yeah. Anytime if you have, so she's got enough money to pay off her student loan, which is what you're talking about, pay it as she goes, then yeah, put the money in here, pull the money out, pay the student loan, avoid that 4% deferred interest.
Okay.
It's a no-brainer to me. And
then one of the ways I tried to describe it to him was like this, and to tell me if where I'm wrong. Okay, my son's name is Ted. Ted, you got $10,000. Okay, you can either take it out and get. This is about taking a loan versus making a withdrawal. Okay, you either take it out, and you may pay taxes on it. You probably won't, but you may pay taxes on it. But you won't be getting 10% interest on it anymore. Or you can take a loan from it and make net 5% money on the money you borrowed. Do you follow my logic there?
So you're talking about using the IRS guidance that's out there right now, where you can take money out of an IRA, early withdrawal without early withdrawal penalty, and then you're going to pay the income tax on it, but then you're going to put it in here?
No, this is him he's grilling me about, later on in life when I'm retired, why wouldn't I just withdraw the money? Why would I take a loan? And I said, well, you got two options. You got $10,000.
Okay. Right.
Yeah.
So that's a no-brainer. So the reason why you wouldn't want to withdraw the principal is because then you're defeating the growth potential. So why would you want to say, okay, I'm going to take, $1.2 million cash, but I'm going to destroy something that's earning $120,000 a year?
Okay.
If you take the principal versus, okay, take a $1.2 million loan, leave all the cash in there and let the thing keep growing $120,000 a year.
And where he's hung up on is like, well, I'm paying interest on the loan, and I'm saying, but you're getting even more interest back.
Yeah, you're the interest, the dividend plus the guaranteed interest is going to exceed the loan interest, which is 4.79%.
Okay. So awesome. Okay. Scott, I really can you move money from a 401k into this? Maggie, the quick answer is yes, but you're going to have to pay.
Not directly.
Yeah, not directly. You're going to have to pay taxes on it. You have to be over age 59 and a half. You can only move half out every year due to restrictions on a 401k. Did I hit everything there, Scott?
Yep. And Maggie's got another question. How does the insurance company make money? Well,
don't worry about that.
Hand over fist. Because of all the policies that typically get written, that eventually, people will sacrifice and take some of the money back or whatever, or maybe they just don't need the policy anymore and cancel, and all those premiums have been paid in. But moreover, if you didn't know this, the largest institutional investors in the stock market are insurance companies. And the reason, and they are, if you look at the landscape of the investment market and who can affect market change immediately, it's the insurance companies. If the general population, which is about 40% of the market, decides all together at one time to buy one stock, it's going to shoot that stock up a couple dollars, maybe. If one large insurance carrier like Mutual of Omaha or Transamerica or one of these big players decides that they want to sell 200 million shares of a stock in 1 minute, then they're going to drop that stock price in that 1 minute a couple bucks. That's one decision one person made. So how do they make money? They invest, and they do. It's called hedging, and they use things called puts and calls, which are betting on whether the market's going to go up or down. And I used to be a bad day trader, and I know that you can make lots of money and you can lose it really, really fast too. But that's why they have folks that's all they do, 12 hours a day, 15 hours a day, is study the market, and they are constantly with their finger on the trigger to stop or get out of a position or get into a position.
Hey, Scott.
Yeah.
I see that question there. I just wanted to touch on that one more thing. The way I've always looked at this and at IULs and at other indexed in the insurance industry is, think of this like a profit sharing plan that the insurance company is allowing you to be a part of.
Yep.
They're making much more money. Believe me, they would not be offering the generous things they're doing if they weren't making much more money on your money. And I like, is it Karen? Who's Kay Martin?
Don't know.
Okay. You want this one?
Well, I wanted to talk, looks like Jeff is getting ready to leave. How can you get more information about this? I've got 3 or 4 videos about this that are posted online on YouTube. You can go check those out. Certainly talk to whoever invited you here. They can give you more information directly. And you can always go to Symmetry's website directly, or just Google Debt Free Life. You'll find lots of resources.
Hey, Scott.
Thanks for coming, Jeff. Is that Christian?
Yes.
Hi.
Hey, Tom just made me think of something. I don't know how legal it is.
I saw the smoke.
Yeah, you know how you always get things in the mail, need money now? You know, let's say $10,000, you know. What's the legality of, say, taking that $10,000, starting one of these banks, you take it out, you pay off that $10,000 you just borrowed, and now you've got $10,000 in your bank?
The legalities are, the carrier is going to ask you a very specific question when you make the application, which is where the fund's coming from. And they're going to look, and they're going to follow a paper trail. So will it work? Don't know.
There's a question on the application, Christian, that says, have you borrowed any money to purchase this, to make this purchase? And they're going to follow up on that to make sure that you didn't borrow money to make this purchase.
And if you answered yes, they're going to decline the application. And if you answered no and they find out otherwise, you're defrauding them.
Okay.
Not a good place to be.
Good idea.
Yeah, it's just the thought that popped in. Thanks, Tom.
Yeah, so we take anti-money laundering training, because that's what you just described as a money laundering method that we are not to be doing. So if you, for example, made an application with me and you told me you were doing that, I would report you to the carrier as potentially money laundering, to CYA.
So,
was just a thought. Just a thought.
Good thought. Don't do it.
So as far as Kay Martin's question, Scott, can I take a stab at this and then you correct me? So the death benefit that's paid your survivors, your beneficiary, is a combination of the cash value that's currently in the policy and the life insurance policy that's protecting the cash value. So as the cash value grows in your account, you're actually paying for, slightly less life insurance, which is bringing your overall cost of coverage down. So if you take a loan when someone passes, when you pass, if there's still an outstanding loan, the insurance company is going to pay themselves back and then give the remaining money to your beneficiary. Scott, how'd I do?
Great. One more thing to add to that. The paid up life insurance policy that you have, the cash value of the PUA, it will never exceed your loan amount. Your loan amount will never exceed that. They won't allow you to borrow 100%. So you'll always have at least 5% in there of the paid up. So if you have $100,000 paid up life insurance, then they'll allow you to borrow up to $95,000. So there will always be money left over. All right. All right, so any last minute questions? Sean, you've been watching diligently. Did you get anything out of this? Okay, we got a smile. Okay.
Hey, listen, Scott, again, I love these classes, love these presentations you do. No one does it better than you. I've had several clients call me up after this and tell me that, you really resonated with them. And as a result, I've got several cases that are being underwritten right now. So appreciate you taking the time out to do this, and appreciate everybody that that participated. This is something we're very, very passionate about. So if you know anybody that's in debt, and I don't know anybody that's not in debt, ask them the question: Are you sure about your retirement? 100% certain you're going to have a great retirement, or do you have some doubts? And then talk to Scott, talk to your manager. Take care of it yourself. But there's $13 trillion of consumer debt out there. We need to get people out of debt in this country.
Yep. Thanks, Tom. And thanks everybody else. I'll later on tonight, I'll go ahead and try to get this posted. It'll probably be up on YouTube tomorrow if you guys want to come back and check it out. Yeah, that's it. So thanks everybody. Have a great night, and we'll see you next week.
Are you and I meeting on here, Scott?
I'll call you in just a second, Tracy.
Okay, bye.
Thank you, Scott.
Bye, folks.
Buddy.
See ya.